For a price ceiling, the consumer surplus goes from here to here, and the producer surplus goes from here to here, and the welfare loss is here. In this video, I'm going to be guiding you through minimum and maximum pricing, explained simply. Before the minimum and maximum pricing, the market is in an allocative efficient state. This means where the buyers and sellers are equal, so the consumer and producer surplus are maximized. If you are unsure about the consumer and producer surplus, follow the link in the description or click here. Our first government intervention is a price ceiling. As you can see in this diagram, the consumers will be paying a lower price of PC from PE, and at these price levels, consumers are more than happy to consume at QD. But in the case for producers, they are only willing and able to supply at QS. And the reason for such low supply is that producers will be receiving less revenue and profit, so the incentive to produce more is less. So as you can see, the consumer surplus has increased by this area here, which was taken from the producers, as they currently enjoy a low price of PC. And since suppliers are only willing and able to supply at QS, buyers can only buy the limited available supply, which is here. And this area in blue is the consumer surplus after the price ceiling. In the case for the producer surplus, as you can see, it has been decreased to this very small triangle here, and the old producer surplus is taken away by the consumers. And due to the price ceiling, we have now created a welfare loss, as we only have a limited supply at QS and demand unsatisfied due to the limited supply here. These were once upon a time mutually agreeable trades between buyers and sellers before the price ceiling, and after the price ceiling, these trades do not happen, which is the welfare loss. And to illustrate why a price ceiling is not good for the suppliers, as you can see, the shaded area in the green is the total revenue, which is PE multiplied by QE. And after the price ceiling, you can see there's a stark difference, as the green box is significantly smaller, which is PC multiplied by QS. Now moving on to the case of a price floor. The price floor increases the price from PE to PC. This leads to a fall in quantity demanded from QE to QD. But due to much higher prices, producers will want to sell their products at QS, which, as you can see, there's a surplus of products. And as the producer wants to supply at QS for more profits, they are only able to supply at QD due to the lack of demand. The new producer surplus is shaded in yellow on the diagram, and the surplus is taken away from the consumer surplus. And in the case for the consumers, the consumer surplus is only this small triangle here, as part of the original consumer surplus is taken away by the producer. And this brings us to our welfare loss. As there is less demand at QD due to higher prices at PC, suppliers are only able to supply what is demanded, which is QD. And once again, these were once upon a time mutually agreeable trades before the price floor. And after the price floor, these do not happen. And now let's take a look at the diagram when there is a price floor with government intervention. The government buys up the entire excess supply, at this point shifting demand from D to D1. The producer surplus increases dramatically, which is represented in the dark yellow triangle here. And the benefits to this is that it reduces excess supply and prevents wastage. However, this is taxpayers' money that we're using, and these purchases might not benefit the entire economy. I hope that helped. I hope you guys have a good day. Bye-bye.